On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to Financial Compass. I am your host, Todd Schoenberger, and joining me as she does every week at this time is Mish Schneider. She is the chief strategist at MarketGauge.com, as well as the founder of the Economic Modern Family channel on YouTube. Mish, welcome back. So we have a Dow Jones Industrial Average as we speak at a record high. The Dow is up 800 plus points right now, Mish. Truly remarkable, but it seems that there's a rotation coming out of the chip stocks and going into the non-tech names. Are you still a buyer of the tech sector?
Well, probably not. We do have our quant models that were long a lot of the stocks that had made massive moves like Western Digital and Micron and Lam Research, to just name a few off the top of my head. And they've all been scaled out on the big rally with profit taking with trailing stops. So the way we would enter new tech stocks would probably be through the quant model. And I did some research about this, so it's an interesting thing to share. And I know you're going to be talking to Keith about this more next week. But we have a ranking system using what we call a trend strength indicator. And it uses a whole bunch of our criteria, but it puts it into one metric. And so unless one of the other stocks that have been on the list, and there's been a few of them more in the software space, believe it or not, like Datadog and I'm trying to think about it, not AppLove, and there was another one. Oh, CrowdStrike, which we know, of course, is down a lot, and a few others like that. They have not ranked high enough to get in yet, but this is a model that by strength doesn't buy dips. So to answer your question, if the money truly is rotating, it would be perfectly okay to see tech take a little bit of a breather. And it would be healthy to see money flowing into some of the other areas. And that's constantly what you and I are talking about, right, Todd, is don't chase strength forever. Things do correct. In fact, my Economic Modern Family, and we just did a whole thing with sister semis. And if you're going to buy dips, buy things that have a good basing action with a very clear risk.
That's right. But it's interesting, though, because you might have this rotation out of the chip sector. However, you still have the inflation concerns. The war is going on. Higher oil prices. We see the big three oil companies right now, as we speak, with Exxon, Chevron, and ConocoPhillips, are actually trading much higher today. So with that, on the energy side, we're obviously going to have higher inflation for the rest of the year. Even if the war ends today and they reopen the strait, still going to take a couple of quarters to get things back to normal. How do you trade that, though, for the rest of the year? Are you thinking maybe I should focus on metals, maybe something more tangible? Give the audience an idea.
Well, I can tell you what we've been focused on outside of the quant models. And by the way, in the quant models, in terms of sector rotation, solar has been a big winner and also been scaling out of that with huge profits. So that's another direct impact from the energy sector, is looking out to solar, which has been great. And I was laughing when I saw Plug Power crash, because that's all about what you hate, Todd, which is the hydrogen power. So yeah, right. So you have to look. But let's take a victory lap here, okay? Natural gas, right? How long have I been talking about natural gas bottoming on this show? For weeks.
Many months.
Skin in the game. So I'm not just talking the talk. And now we're finally starting to see some momentum to the upside. So we're in we got in at around 11:30. I haven't looked in the last few minutes, but it looked like it was approaching 12. And we do have a 200-day moving average in at 12:45, which means if we can get through there and look like we're going to hold, it's an add point, or if you've been not watching our show, might be a good time to enter, but of course your risk is going to look much different. And if we look at the futures price here, which of course is always my suggestion, is to look at the underlying at the same time, and we go to the chart. What's so interesting about natural gas, and of course I'm looking at July, is last week it cleared the 50. The slope on the 50 is starting to neutralize. It had been in a down slope, which generally means that if it crosses over the 50, it's a weak move. You want the slope to neutralize and point up. We're above it. And if we get through 340, I see no reason why we won't test their 200-day in futures, which is more like around 363. And if we, go ahead.
Well, I was going to say US futures for natural gas are trading between $3 and $4, and then you have Europe that is dramatically higher. I mean, is it
Exactly.
just too obvious? I mean, is everyone missing this? Because it seems like that trade, and you have been a huge bull on this side. It seems like it's just right there for the taking. But what do you think?
Well, people call it the widow maker. People are terrified of natural gas. And yet, it's been, in terms of through the years, like after COVID, it's been one of my greatest winners when you let it ride because, like every single commodity, it can sit dormant and be very frustrating and sell off. But when it gets going and the emotions get hot, it's exciting. And at the same token, it's not a stock, it's not a corporation, it's a commodity. And so you have to actually sell into those big, big winners and then trail up stops. So this is exactly why people go, oh, natural gas. Oh, first of all, there's a lot of it. And secondly, I'm just going to lose money in that. And that's why we have this show, right? Because we've been trying to direct people into how to trade it. It's something I love doing. When I was on the floor, I was a member of NYMEX, and natural gas was one of the triads with heating oil and crude oil.
Yeah, I mean the launch of the Financial Compass series has been just amazing with the timing because we're now going through that AI boom and it has really paid off. I know our audience numbers are get they just continue to accelerate every week because of this show because you give some great advice on it. So with the AI trade, which areas do you believe, Mish, right now are going to be the ones that are most successful? Do you see it in electricity? Maybe nuclear, natural gas. What about grid infrastructure? I mean, if you're a new investor and you want to get into the AI trade, where should they look first?
Well, I like to look because I am so commodities oriented. I do like to look at the power grid itself. And that's why, we looked at crude oil, but that's kind of its own animal right now and not necessarily used for the power grid because it's going back and forth with Iranian news. But you want to continue to look at some of the metals too, the conductor metals like copper, which has done very well. Now, looking at silver, it's been sort of asleep at the wheel. It's like that classic thing we were just talking about, right? It goes to sleep. It goes into the doldrums. People buy it thinking it's going to move. Then they get out because it hasn't gone anywhere or it sells off suddenly, shaking out the week longs. But we've been consolidating above that $70 an ounce. And if I like to look at the charts while I'm talking because it just sort of helps me frame. We're at $74 an ounce right now. We're still in smack dab in the middle of this consolidation that we've had. So I would say at this point, I'd like to see it get back over the 50 at around $77 an ounce. And then I think that would be a good play. We're already long gold and we're already long miners, which is going to require some patience. Gold, not for the energy play, more because of other things that I've been seeing in the market. But the miners are another one, and XME has been really hot. That covers a lot of the minerals that are needed in AI, like aluminum, for example, on top of copper and a few others. So, you can always look at ETFs where you get exposure to a lot, as opposed to choosing A, the future, or B, the ETF totally directed to the future. I mean, if we look at like what has been one of the hottest stocks around, in terms of the AI space was MU. And MU right now just gapped lower today. So you don't want to get in right now because you've had a massive amount of longs. But that would be something that if we can see some kind of a decent retracement down to maybe 900, so this is where we've been doing these videos on how to buy things that are already too high, when you can buy momentum, but you got to be nimble and then wait for things that are actually correcting. And Marvell, of course, has been the big thing after Wang talked about it. And right now that looks pretty solid too. Again, you just have to be careful of risk. So I would keep my eye on that because he said this was going to be a huge, huge part of the business. And so I think if it gets through today's high, you have a risk to today's low. And that would be probably maybe my favorite play right now because, you might as well follow what the big guys are talking about.
Yeah, Jay Hatfield on Hatfield Economics, another show that airs on BTT, has been big buyer of Marvell, and I know his clients have been enjoying that run up. So he still continues to beat the drum on it, and that's definitely been one that everyone should keep a look at, continue to look at. But the one area in the commodity space that we really rarely talk about, Mish, is copper. You just brought it up. It's considered the metal of electrification. I mean, with everything that's happening with AI, do you think that there might be some opportunities there to get into a copper trade, at least for the next couple of years?
Well, again, you're buying now into some resistance. It just made a big move starting at the beginning of May, and it went to a high over about 670. And now here we are selling off a little bit. So I might be reticent to get in right now. But again, this is the kind of thing where you don't want to necessarily get into the highs of it unless it takes out those highs. And then, of course, you adjust your risk, but instead wait for some kind of correction. So where could the correction be? It may never sell below 640, and if it holds as a wall, then that's not a bad point. But at this point, looking at this, I think it has a chance of getting back down to around 620-ish. And that to me would be probably, for me, the best area to buy. Why? Because the 50-day moving average is right underneath it. And then you would know exactly where you were wrong with a limited risk. You know, I keep hammering this home, Todd, to our viewers, is commodities have to be traded with skill. You just don't run in. You have to understand how they move. They're very attracted to where they break out from. It's almost like a magnet to moving averages. They run on momentum, and when you get something screaming like we saw earlier this year with silver or gold, that's when it's fun. But you don't want to establish a core position that you're going to hold until you really understand your risk. And what's so interesting about that is we got to talk about DBA and all the grains, which have just fallen apart all of a sudden.
Well, let's talk about that then, because what is the story there, Mish? That doesn't make a lot of sense. Here you are at the beginning of the summer. The farms are obviously the crops are coming in. I mean, is this just buy at the or sell at the top and then hope for maybe getting some more right, opportunities later on? But give the audience an idea.
You know, I myself is surprised by how much DBA, which of course we know is a conglomerate of both the softs and the grains, has sold off. I would have expected some kind of sell-off because it sort of really peaked out there up above 28, but I would have never expected it. I thought it was going to stop around 26.80 this morning. In fact, I was going to get in. We got out because, you know, we take profits. This is the thing. You know, this is why I keep teaching, because I'm an actual living example of how to trade these things. I had told you guys months ago to buy DBA in March when we were doing this show that it looked like it was going to accelerate, and it did. But again, you had a nice move, and once you peaked and gapped lower the next day, I started putting my stop right underneath that gap, and we got out. And we got out. It's great shape, over 28. Now here we are at 26.64, where I did not expect to be. So now I'm thinking, are we oversold? Is that the end of the move? You know, remember, price pays. We haven't seen the headlines to support that yet. But nonetheless, soybeans, wheat, corn, they're all taking a tumble here, being reflected by this DBA. So now I'll see what happens more around the 200-day moving average, which isn't even that far away. It's like around 26.30. Or wait for some kind of good reversal off of today's low and today's high with some volume.
Let's talk about gold and silver. Silver is finally starting to show some life again. It's been kind of dormant over the past few months. Do you believe now in the second half of the year that silver may actually outperform gold?
Well, we certainly have to keep our eye on the ratio, and right now that's come in a little bit. In fact, bad me, I did not look at the ratio. Go to silver ratio. Let me look it up here. So, you know, I always like to speak with authority because, you know, your memory only takes you so far, right? So the gold to silver ratio right now is back over 60, 50. It's like 61. Remember, it crashed down to about 54. So right now we're seeing more in the favor of gold. So I would say if we got to see that ratio down below, let's say 60-30, that would probably mean that silver is going to take a bigger pop. But I am in silver from like, you know, like it seems like 1,000 years ago. But what I did buy this week, because of what I'm seeing, and also because I still feel that gold was just sitting there waiting to be bought is we bought gold. And we bought gold, GLD, of course, we didn't buy the futures, but we bought it against right here, the 200-day moving average when it was trading at around 44.50. Now today it's back over 45. It needs to do more work, but I would add to that, but I only did a nibble. I would add to that position if we can get back over, let's say, 45.40, and then just like if it closes back under the 50-day moving average exit, that's a pretty tight risk for gold. If you can buy it at 45.50 and be out at 44.75, you could take a $75 risk in something that's trading $4,509.
Right.
That is about as good as it gets for gold. So I'm not necessarily saying I'm madly bullish because it hasn't proven yet. But what I am seeing is buying coming in against a major support level with a low risk, which gives me the opportunity to take a small position. And then if I'm right, it's going to break back over the 50, which it has not been above since the middle of March. So we're talking March, April, May, June, 4 months we've been under the 50. That would be significant if it gets back above it.
Yeah, absolutely. Now let's turn to Bitcoin. I know you've been in touch with a very famous Bitcoin investor. I'm not going to give the name out. I'll let you do that if you wish. But what's the story? I mean, what because the audience wants to know. I mean, is this the time to go in long, very strong here, or what do you maybe stay away from it?
Well, yes, so we're not going to mention the name, but he's a Gen Z and he's brilliant. And he spends his life studying cycles and things about Bitcoin. And he's always been one of my premier advisors. I made the most money in cryptocurrencies when I was following his lead. And so I hadn't heard from him for a while. And it's funny because we were on the same wavelength. I was thinking about texting him this morning, and then bam, he texted me right before the show. And here's what he said. He said that each 4-year cycle's bottom has occurred between 889 to 994 days after the most recent halving. That's how specific this guy gets, right? So
Hmm.
he's excluding the 2012 to 2016 cycle. Then there was a bit of a tighter window, 889 to 910 days. So he's saying if we assume that this is the same thing, that the cycle or 890 or 900 days from now is actually in October 2026. And that would be the last after the 900 days after our last halving, which was in April of 2024. So he thinks the summer could have some rallies, but they'd be fake outs. We could see a lot more blood, and that probably you stop buying the hell out of it sometime in September, and that we would see the bottom in October based on his research. Sounds good to me. I mean, one thing I've seen is so much negativity. It's going to zero. It's worthless. It's this. It's that. I don't believe that. I think that people just love to hate crypto, mainly because they didn't make any money in it. But that's the best I can tell you right now is probably if you want to actively trade, that's one thing. If it gets a little too oversold, but be nimble and look for that bottom somewhere in September.
I like that. I mean, if it does go to zero, Mish, I'll buy it and I'll buy it on margin. So that'd be great.
Exactly. I don't think it's going to go to zero, though. I mean, right now it hasn't broken where it was just a few months ago, which was 58,000. And now here we are, what, around 62 this morning,
Hmm.
63?
Yeah.
You know, I like to look at these sort of areas that clear. It could go back up to 70 and fail because that was a huge area of breakdown. So maybe if it's oversold now and you're really quick, you can get a quick move out of it. But I think there's far more interesting things to trade at this moment than cryptocurrency. I have some in a long-term Coinbase account that I don't touch. I just leave it there. That's like, for my grandkids one day.
Yeah. No, I completely understand that. Let's turn now to the economic modern family. For those in the audience, you can go to YouTube, key in economic modern family, and click subscribe. So, Mish, with the economic modern family framework right now, which member of the family is leading the market narrative this week?
Well, it's certainly been sister semiconductors. I mean, no doubt. Yesterday, SMH made a new all-time high. And of course, we're getting a little bit of correction with some of the corrections that we're seeing in some of those tech stocks, but it's not much of a correction. And so actually, I think it's probably good. It was getting just a little too frothy, but leader beyond the beyond. And so that's where the conversation has to be. Because remember, we talk about this too. When one sector of the family gets overstretched, one of two things happen. Either it pauses and the other members catch up because they say, oh, things are better than we thought, or the reverse. The others start to sell off more, and Sister Semiconductors and everybody that's in it says, maybe I better liquidate and raise some cash because my other positions aren't doing well. You know, people tell you they're all in tech stocks and they've made a fortune and they've never lost any money. I think that's pretty funny. The other, yeah, and right behind that is IYT. Believe it or not, transportation. You would think the gas prices would impact, but actually, I just wanted to. Another thing that I read this morning was Lizanne Saunders. You know, she puts out a lot of great information, and she put out this morning a tweet that said that April factory orders soared over 4.8% month over month versus 1.8% from the month before. That's the largest gain since May 2025. And it was mostly driven by transportation equipment orders, which jumped 22% in a month. So what does that tell you? That is probably the best news that I have heard for the economy, is that we're bringing industry back and we're starting to see orders come in. That's healthy. That's why I can't really get too bearish. I mean, there are cracks that I see, but that's another story. So watch that transportation because it made a new all-time high this morning, backed off a little bit, but I keep my eyes there. And if you want to look at the weaker members of the economy, you want to look at, first of all, KRE, but that actually has come back a little bit. And I heard Goldman Sachs finally took off. And the other one, of course, would be Granny Retail, the consumer. And right now it's pinched between support and resistance, but I still see quadruple bottoms there. So if that gets going back over 85, there's a lot of retail stocks that have been beat up. When you ask me where I want to put my money, that's what I'm waiting for, is Granny to show that the consumer isn't that bad. And tomorrow, of course, we have the jobs report, and then we'll take it from there.
So of that, with KRE and this Granny Retail, are those the two areas that you're most concerned for right now?
Yes, however, they both made a miraculous recovery after looking like they were going to break down under their 50-day moving average, particularly the regional banks. And there's so much talk about credit defaults. I've heard all these different stories. So right now we're not seeing it. And of course, the consumer is always my biggest concern. And like I said, if it breaks down under 81.80, I wouldn't want to be long very much of anything. Because of these other things that I'm seeing that we don't have to get into now that could be potential fissures. But if it gets back over 85, again, we got another reason to believe that we're going to see another rally in the market, and maybe AI won't be the leader, but maybe at least we'll see some nice catch up in some of these other broader economic areas.
So what is the economic modern family telling us about the economy, say over the next 6 months?
K-shaped. I mean, really, basically, it looked for a second there like the bottom part of the K was getting even more stretched and the top was looking better. But I've actually read now that there is the K is starting to get a little bit more equalized. I mean, that's what it's telling us. It's telling us that we're not in a recession. Hyperinflation is not really a terrible concern at this point. And we're certainly seeing that in some of the commodity prices. And yet, compared to what we've seen in the AI sector and tech, the consumer is still feeling the pinch. So it's not a very clear picture in that not everybody's happy, but it's also not as devastating as one would think it could be at this point in time.
So, but those signals, though, are they leaning more to the economic acceleration side or the economic slowdown side?
Both, right? I mean,
Okay, they're running parallel, it sounds
they're
like.
running sort of parallel, right? That's why, I've been trading, of course, but I've been very careful about what I'm doing. And you probably have noticed trading has gotten a little bit harder here because you buy a breakout, the next thing it comes in much lower and you go, "Ooh, what the hell happened?" And then you buy, a support level and you might get one quick rally and the next day it gaps down below support. I mean, we're seeing this over and over, especially with earnings, the most recent earnings being kind of a surprise to the downside. But if you really want to see how the economy is doing, you got to watch the retail sector and watch some of the big stocks in that area, like Costco, for example. Costco tumbled with fear, and now it held the 200. This is why yesterday was the perfect buy in Costco, because it cleared the 200. You had a great risk, and today it gapped higher again. But it isn't really impressing me yet. It could just be a short covering rally. That's why I say it's mixed. We don't really know if this is the healthy rotation back into these names, or if this is just some short covering rally, and that's about that.
All right, final question for you. I'm going to do my best Bob Eubanks here. Finish the sentence, Mish. The market is getting this. The market is wrong about blank.
Rates.
Rates. Okay. All right. I like it. That's
Yeah,
all I needed.
this is not a new topic for me either, talking with you, but I'm a huge, huge watcher of the long bonds. We bottomed out earlier in May, and now here we are into June. We're above the 50-day moving average, so we're back in a recuperation phase. The momentum is looking pretty good. It's starting to tackle outperforming the SPY. And if we can get through, say, 86 in the TLTs, not only do I think that that would be a great trade because it's been under pressure for 4 years, but it would also give Wash a pass. He really wouldn't have to do very much because the economy's humming and the yields would just go down on its own, maybe because of some fears of an inevitable recession, but it doesn't matter. We don't have to worry about that.
Okay, I like it. Mish, we're going to leave it there then. And for those out there who don't know who Bob Eubanks is, just Google the Newlywed Game and you'll find out. So that's great. Mish, we have a very exciting show that's premiering next Monday, by the way. I think you know the gentleman, Keith Schneider. We have a new show called Keith's Corner. It's going to give us a behind the scenes look at what a portfolio manager is actually thinking when they make their trades. I'm sure you may have heard about it a little bit, but I know I can't wait. I'm sure you can't either.
Well, yes, and speaking of the Newlywed Game, we've been newlyweds for over 35 years.
Beautiful.
So, yeah, no, it's very exciting because Keith rarely talks publicly, and yet he is just a whirlwind of information. He's the creator of all our quantitative models. He was on the floor even longer than I was, and he's brilliant. He's brilliant. So he's going to have a lot of great stuff to offer you.
Yep, he is absolutely brilliant, and he is a Wall Street encyclopedia, actually, when it comes to trading and those quant models. I know the audience is going to get a lot out of this, and I know I can't wait to talk to him. So that debuts on Monday at 12 noon Eastern time, so you definitely want to tune in, and we will be airing live as well. Mish, let's leave it there. We're going to be meeting again next week, next Thursday, 12 o'clock live. A lot to discuss, one of which is going to be the jobs report. We didn't even get into that, but we will next Thursday as we break down the information and see what that means for the Fed and the overall economy. But I do appreciate you coming on today.
Thank you so much, Todd.
Absolutely. So on behalf of Mish Schneider, I am Todd Schoenberger. Thank you once again for joining us on Financial Compass. Coming up at 3 o'clock live, Joe Madden. Boy, does she have a lot to talk about. She's going to talk all about Game 1 in the NHL Stanley Cup, as well as the NBA Game 1, where the New York Knicks won Game 1 against the San Antonio Spurs. And she's going to give you a full analysis of what you can expect for Game 2 in both of those series. You will want to watch 3 o'clock Eastern Time live today on BTT. Until then, take care.
We're the economic modern family. Watch the flow. Market vibes tell you where the trends might go. We're the economic family. Guiding the scene from the streets to the screens to your trading machine. Tap in, stay tuned, feel the beat line, cause the market tells a story through the family.